So, property in trust, the rules just changed. So, I thought I'll do a quick video on the topic as I've been getting a lot of questions from clients asking specifically how does that impact them. Whilst 50% CGT discount has been great and will continue to be great for some time, indexation not necessarily is such a bad thing. I mean, if you look at it, inflation as it sits today and indexation is synced in according to that, potentially indexation can give you better outcome than 50% CGT discount. Let's look at it in a bit more detail, how that works and how it impacts you. A little bit about me before that. My name is Amit Agarwal. I am fellow CPA, SMSF specialist advisor. I'm a tax agent and a broker who has been helping high income professionals to build, manage, and protect their wealth over the last 10 years. There's no need to panic. You need to sit down with your professionals or reach out to us to look at comprehensively how this impacts you. Do some numbers. Numbers tell the reality. Short version of the story, trust is still solid structure, according to me. It just stopped being a favorite tool for tax. A lot of people go into trust thinking they can distribute to their dependents who are below the tax-free threshold or are not earning income. That shortcut has gone away. Other than that, trusts are still effective tax structures in some shape and form. Let's look at it a bit more closely, how it works. Before we jump into what has changed, let's look at it why it was such a favorite tool for people to buy properties. As I mentioned before, you were able to split income to lower taxed family member. It was 50% CGT discount, strong asset protection, which still is the case, succession planning and estate planning tool. It still remains relevant for a lot of people. Okay, now let's look at it. What has changed and what are the key dates for those changes? Two changes that are happening and the effective dates both are down the track, not right now. Now, the two changes, obviously 50% CGT discount goes away and indexation method comes in. And the second change is all the trusts will end up paying 30% tax. The beneficiaries will get tax credit, but if your tax slab is below 30%, you will lose the credit that you have got from the trust. Nothing changes today. As on 1st of July 2027, CGT discount gets replaced with indexation method. Now, it's important to understand here, if you bought your property before 12th of May 2026, you still have the 50% CGT discount available. Indexation method is an option for you to rely on. You can choose either or from those dates. However, if you bought your property after 12th of May 2026, you don't have choice. As of 1st of July 2027, the only method available to you will be indexation method for capital gains calculation. Then comes 1st of July 2028. Now that is when 30% tax on discretionary trust kicks in. It's important to understand there's still a lot of time to understand your position and reinvent yourself if you need to. Tax efficiency has been reduced. Income splitting and CGT discount loses its punch for family members on less than 30% tax rate. One thing you need to understand is any gains built up to 30th of June 2027, the old rules will still apply, even for the properties that were bought after 12th of May 2026. You need to be aware of it, that that is the date when you need to get your properties valued or businesses valued, if that's the case. I've been asked, or there is a lot of misconception that they were supposed to get the valuations done 30th of June that has gone, or the next 30th of June. No, it's 30th of June 2027. That's when this rule will kick in. There is 3 years of rollover relief to restructure if it makes sense to your personal circumstances. So I've done a couple of examples to look at how numbers flow with old rules versus new rules. I mean, if you bought a property for $500,000 in 2020 and you sell it for $900,000 in 2032, a realistic time frame, and the property is held in discretionary family trust, under old rules, it's simple. You get 50% CGT discount and you end up paying $55,000 tax on it. Under new rules, the potential tax will be around $65,000. That's assuming you split 50-50 between the two spouses. You will end up paying $10,000 more under new rules. Indexation does impact you in that sense. Now, let's look at it. If we were to distribute differently compared to 50-50, how does that work? Same scenario, if you buy property for $500,000, sold for 900, one of the spouses is earning 95, the other is over 30% tax slab. So we end up distributing more to the spouse who is on less than 30% tax slab, taking her effective income to 30%. And you will see from here in two scenarios, the tax is exactly the same. Obviously, there are a lot of underlying assumptions in this, but the whole idea is to help you understand, whilst there could be tax difference, there are ways you can manage this better to get better tax effectiveness. See, as I mentioned, there is zero difference. Indexation produces same 200K taxable gain as the old 50% CGT discount. Like I said, we need to understand what hasn't changed in this situation. Asset protection still works, and I still believe asset protection is more important than tax planning in a lot of ways. Again, succession and estate planning still works. The family home exemption is untouched. Super tax treatment remains unchanged in that sense as well. So what is my suggestion to anyone watching this? There's no need to panic. You need to sit down with your professionals or reach out to us to look at comprehensively how this impacts you. Do some numbers. Numbers tell the reality. There are a lot of gurus out there telling you what has happened and how it is so bad. You really need to sit down and do your numbers and understand what works for you and what doesn't. Like I said, if you hold property in a trust or planned to, the maths definitely has changed. However, it's not like it changed yesterday and you have to do things now. There is still time for you to look at the impact, restructure if you need to, or continue to do what you were doing. New structuring decisions should be made after understanding the rules rather than just randomly making calls to change the structure, which I've had a lot of them recently. Should I be restructuring? And I'm like, why is that the case? Let's look at your position. Let's understand how it will impact when you're looking to do certain things like selling an asset, and then put some numbers in place to see how that works. So there is a bit of maths to be done before you make any decisions in that sense. Like I said, there's no need to panic. You need to review your position. Let's map your structure while you have time to plan. Plan it properly and execute knowing your situations. One thing you need to be aware of it is with the drastic changes that has happened over time, we are witnessing a lot more changes in rules and legislation throughout the year. Once in a year, tax planning or visiting your professionals is no longer the way to go. You need to be more on the money and keep on having conversations with your professionals if you are using trusts as structures or are looking to do more with your money.